Boom, got the recording going. Hey, everybody, Eric here. And I have a gentleman actually that I came across probably a month or so ago, and I was following him on Twitter for a while just to kind of see. And I reached out to him because I really liked a lot of the stuff that he was talking about. So I'd love to introduce everybody to Gregg. I know that he has a wealth of experience with investing. So first off, welcome to the show. And then I would love to dig into your background a little bit.
Thanks, Eric. I appreciate you having me on your show. I really do. I've been watching your channel and I really enjoy the videos.
That's awesome.
Sorry?
I said that's awesome. That's the whole point of the entire endeavor is just have good conversations and share fun stuff.
Yeah, that's it. Well, my name's Gregg Gossett. I've been a full-time trader for almost 25 years now.
There you go.
I have a channel on YouTube called Gossett Trading and Mentoring Live, where I teach and trade and mentor each day during the last hour of the market on YouTube. And that's probably how we found each other, or maybe it was Twitter, one of the two.
Yeah.
Like I said, I've been trading for 25 years. In my early 20s, I came up with an idea for a chewing gum. And the idea really took off and it turned into a big company. We did like functional chewing gums, like weight control gums, energy gums, things like that. And it really took off. And I was fortunate enough to have my company taken public, and we did really well in the market. And at a pretty young age, 25 years old, I, basically cashed out, and I thought, well, what am I going to do going forward? And I had a friend of mine that had just got involved in trading commodity futures. And he said, hey, you might like this. And I kind of dabbled in it, and I immediately fell in love with it. And it was a horrible combination. I was young, I had a lot of money, and I had no experience. And when I started off and I did really well. So I thought, man, I must be some kind of natural at this. But, don't confuse brains with the bull market. And you probably know what happened after that. Then when the market turned down in 2000, 2001, I just got annihilated. I lost over $1 million in a month, just a little over a month.
Brutal.
And I had to do some soul searching, and what I did was I walked the coast of Oregon that summer with my dog and just thought, what am I going to do? I like trading, but do I want to continue trading? And, after I got real honest with myself, I just realized I had no idea what I was doing. I wasn't adjusting for volatility. I just all the things you're supposed to do, I didn't do. And so I realized that I was gambling more than anything having to do with trading. So I said, okay, I am going to really learn how to trade. So I read tons of books. I went to countless seminars. I even hired some different professional traders to help mentor me. And through the years, I did study one-on-one with some of the really great traders and extensive one-on-one teaching and mentoring, like Stephen Burns and Dr. Alexander Elder and Kerry Lavorne and Larry Williams. And so through the years, learning these different approaches from these 4 different gentlemen, I put together, how I trade right now. And it's very conservative. It's equity, it's swing trading, multiple time frames. And, when I follow the rules, things go pretty well. And that's what I teach. That's essentially what I teach on my daily live stream.
Yeah, that's something that I think is really cool. When we talked the first time, I always love having just the opportunity to connect with folks that have been in the market for, over 2 decades. It's super helpful because for a lot of folks, one that listen to the channel, and even myself, I've been trading for 13 years, which is a while, but it still pales in comparison, to the breadth of market that you have seen. And it's always very interesting to kind of tap into that experience. Especially somebody who has a really diverse set of mentors that have molded you, to be the trader that you are. That's always, again, just another interesting component. So one of the things I was wanting to ask you is, when you first decided that you were going to go, full-time trading, what did that look like for your general approach to the market?
Are you talking back when I didn't know what I was
Yep.
doing? Well, okay. So like I said, when I started out pretty well. So
Right.
if I didn't have additional finances to live on, I would have thought, yes, I can do this. But
Okay.
when I started to lose poorly, you know, luckily I had other finances and monies, but I thought this is the toughest job in the world. I mean, if I had to actually live on what I'm making and I wasn't making, I was losing,
Right.
this would be almost impossible. And even today, I mean, I make my living trading, but even with as much experience as I've had, and like you said, I've seen all sorts of different markets and different market conditions. It's always a grind. It's never easy, and that's why when I see beginners start out and they do well, I just think, oh man, you just haven't been through the right market yet. You haven't been
Right.
through the right conditions. Uh, when you trade for a living, when you really have to live off of your income, I think you really understand how important it is that you follow every single rule, even though every fiber in your body doesn't want to take that loss. You have to take that loss. Even though every fiber in your body doesn't want to take the next trade, you have to take the next trade if it's part of your plan. I mean, so it's a grind. Trading for a living is a grind. I mean, it's feast or famine. Sometimes you just feel like you're
Sure.
never going to have another losing trade when you're on a nice winning streak, and then other times you're going to feel like I'm never going to make a penny again. But
Right.
it always does change, luckily.
Yeah, and one of the things I was curious about, my mentor, he's been living off of his investments for like 20 years or so himself. And I've been spending a lot of time talking with him about some of the change in his mindset and approach, essentially when he turned on to living off his investments by developing his account. And really, it's kind of a selfish question, because that's where I find myself is at this point right now. Well, really, as of 2 years ago, I could support myself off of the account, and then still continue saving a little bit on the return so that I can continue growing the account. But right now, my fiance, she really enjoys working. So pretty much as long as she's working, I'm going to keep working, because what the hell else am I going to do?
Right.
But I've been thinking a lot through, what does that look like for me when it does come time to essentially stop working and just do this to support us, and so her and I can do whatever. And I would love to hear a little bit of just your wisdom on some of the change in perspective you had while going through that learning phase of living off of your account, until you started connecting with some of those folks and learning how to apply those rules and stick to them. What other kind of things do you think that really resonated with you as you started becoming more efficient and better as a trader, specifically living off of those investments?
Well, it's very important to have a good, solid trading plan
I love that.
that, you know, when I teach and when I do all and when I trade, I mean, the I guess I'll just go through the list. I mean, the number one thing before I take any trade ever is I have to, decide what my position size is, how many contracts, right? How many shares. And that's a function of volatility. I find very few people adjust their position size based upon what volatility is at the moment. They're just like, I'm a straight 500 share buyer. Well,
Right.
if volatility's gone up 3 times, it's like buying 1,500 shares, right?
Right.
So, I always adjust for volatility. I always look for a construct of a trade where I have a very definitive line in the sand, and So if I'm wrong small. If I'm right, I have the potential for a big win. But you have to have something very definitive there, whether that's a moving average, whether that's an RSI level, an ATR channel. And I like to buy as close as I can above that 200-day moving average, so that if I'm
Got it.
wrong and it closes below, I'm out for the smallest amount of loss. But on the other hand, if I'm right, I have to have the courage to stay in that trade and risk open profits uh, to make more. I look for combinations, confluences of indicators. That's my whole approach to trading. I look for confluences, different combination of groups of buyers coming in, ideally on multiple timeframes. I mean, I look at moving averages, RSI, ATR channels, V1s, V2 entries, all these kind of things. I look as potential groups of buyers, and you will put yourself in the best position. You'll improve your odds dramatically to have a profitable trade if you're in the company with as many other buyers as possible. So if if we take the opposite extreme, if you're the only buyer and everyone else is selling, it's going to be very difficult for you to have a profitable trade. So I look for
Right.
confluence, combination of indicators, ideally on multiple timeframes. I construct a trade so I know if I'm wrong small. If I'm right, I have the potential for a large win. I'm very aware of how correlated my positions are, how many stocks I have. Ideally, I want to have stocks in different industries. I don't want to have 4 tech stocks, right? Because they're
Got
going
it.
to go up and down together. I like to get outside of equities. I don't trade futures, but of course, in equities through ETFs, you can still trade oil or gold or bonds or
Right.
silver or something like that. And also, I like to, I use 4 or 5 different trade setups. And in an ideal world, each one of the trades I had would be a different setup, right? One might be a trend trade, one might be a deep dip buy, one might be a return to value. So when you're trading for a living, you better make sure that you have all these things lined up. And even if you have them lined up, it doesn't mean you're going to make a trade. But
Sure.
what it means is that if you're put yourself in the best position, take everything to an account, make your trade. If you're wrong, be wrong small. If you're right, you have the potential for a big win. And if you're not trading for a living, I understand, because I did it for many years, just the excitement of getting into the trade, just trying to take a stab at it, but when you're trading for a living, when you really have to pay your bills for a living, you better have all those things lined up, and you better stick to the plan.
Yeah, and I think one of the things that you mentioned is really important when discussing the concept of living off your trading is the fact that you do a lot of swing trading. And when I talked to my mentor about that, one of the really, I don't know, it's a small detail, but a lot of people don't think about it. Buy and hold doesn't really work for folks that want to live off of their trading unless you are really good at amortizing your income at the end of the year, when you close for profits or whatever. Like when you're swing trading on whatever basis, you continue to take profit in, realize that profit so that you can then spend that on whatever you want. Um, so one of the things I was curious about is how do you integrate your expenses into your trading plan? Or do you essentially have like a monthly target that you want to hit that to cover your expenses? Is that your approach?
Oh, it's a good question. I used to look at trading like that, but I don't anymore. I've
Okay.
gotten to the point where I don't say, "Hey, I have to make this much every month," because honestly, I, it's not reality.
Okay.
You wait, you're patient, you take the trades. The market's going to give you what it gives you, and it may not give you anything for 2 months, and then the third month it might give you a windfall, right? So, but to think I have to make this much each month, if I have the mindset that I have to make this much each month, then if I haven't made that much so far that month, I'm going to push and take trades that I probably shouldn't take, because I said to myself, I have to make this much. So I literally, the old saying, the Warren Buffett saying, there's no 3 strikes rule in the market. And I literally wait, I sit back, and I just sit on my hands, force myself not to trade until I have something that really fits my criteria and comes by. And that, that's the discipline of trading. And the longer you trade and the more you've made, the more you lost, you realize how important discipline is. I mean, discipline, trading psychology, that's the number one skill that you'll ever have in trading, that you
Right.
should try to achieve in home. Exits, entries, as long as you're putting yourself in for a good, risk to reward ratio and getting out quickly if you're wrong. I'm not very fussed about the methodologies people use, but coming up with just a basic trading plan, I think, is all you need, but you have to be able to follow it. It's like diet, right? You want to lose weight. Okay. You have to eat better foods. You have to exercise. We all know what works,
Right.
but following it is the whole other thing. And if you're not trading for a living, if you have another job, okay, you have money coming in somewhere else. So you can fudge a little bit, right? You don't have to be as precise, but like poker players, professional poker players, they really have to play correctly. They're not doing it just for fun. And I'm not just doing this for fun, but, in addition, I do sell premium quite a bit, but not just out of the blue. I mean, it has to line up from a technical standpoint as well. So, that is part of my income also, is selling premium with
Got
options.
it. Yeah, that's it. Realistically, that's how I got into selling premium so frequently, because that's essentially all my mentor does. Is
Yeah.
he uses pretty much only short puts in IWM is essentially all he does, and he has a
Mm-hmm.
really well developed plan. And on that topic, I am one of the few, I would wager, kind of younger traders that have come across, especially in like the different forums and whatnot, especially for like the real young folks, like the early 20s, those people that are really getting started. And I am a huge advocate of creating a trading plan. And I have just a bunch of videos on it, some ideas to lay them out and those kinds of things. One of the components that I find to be quite difficult is one of the reasons why I think it's easier for you and I to follow our trading plans is because we trust it. It's built on experience, and it's something that's been kind of practically applied. And
Mm-hmm.
we know if we follow this plan, there is a certain set of outcomes.
Yeah.
One of the things for a lot of new traders, I think, is they don't necessarily have that experience to draw on to
Yeah.
sketch out this plan. So it becomes difficult to follow a plan that they don't trust.
Yep.
So one of the things I've been, just exploring personally is in these conversations is trying to find ways to help people trust their plan as they're making
Mm-hmm.
it. And I'm
Mm-hmm.
curious how you've approached that, topic with your folks, because I'm sure that, kind of things come up.
Yeah. So I think I have a good suggestion, and you're 100% right. People might read about an approach, they may see the back tested results, but they still, they haven't actually traded it themselves, gone through it, so they feel comfortable. My suggestion, and I didn't come up with I've read this in many books, but I use it myself, is regardless of what regardless of what approach you're using. I mean, if you're a weekly trader or you're a daily using daily bars, take a day, switch your computer screen, switch your charts to 1 minute bars, and watch those patterns play out and play out all day long, because the patterns on 1 minute are the same as on 5, is the same as on an hour, same as on a daily, or same as weekly, right? Because they're fractals, they're time
Yep.
periods within time periods. And so, if you're buying return to values, well, if you're really trading it, you may have to wait a long time for something like that to happen. But if you sit and watch a 1 minute chart or even a tick chart, you'll see those patterns, and you get repetition. You get the
Right.
reps that you need, because you see them flowing in front of your computer screen. You might get 6 or 8 different patterns that happen every day. Take a month, spend all day watching a 1 minute bar, look for your pattern, look for your setup, whatever it is, but just you get the high frequency of turnovers. And even if you're not trading it for real, even if you're just paper trading or just observing, I think then you'll see, and then I think you'll get the confidence that you'll go, this doesn't work every time, but it works more times than it loses. And I think seeing that will give that trader the confidence to actually express the trade on the time frame that they're actually using.
Yeah, I think there's a lot of value in that. And the other piece I typically add on to that when I'm having conversations with folks is doing their absolute best to create a good tracker of information of what they're seeing.
Mhm.
Because when I was developing my approach, my trading plan, it started very much off more of a hypothesis driven, if I do this, I'm expecting this to happen. And if I do this, I expect that to happen. And I would kind of play out those two different hypotheses simultaneously. And I would track very carefully the way that I was adjusting trades and whatnot to see, kind of what worked out. But to your point, it's essentially finding the best possible way to put yourself through those paces so that you can start to trust the document. I think paper trading is really good for that, especially. I don't remember if we talked about whoever your broker is, but I use TD Ameritrade, and they have the think back feature, so you can like go back in time and then turn it on, and the market acts just like it was that day in history.
Oh,
So
nice.
yeah, so it's actually a really, really convenient way to help people accelerate what they see, because otherwise the market only moves at the market speed. You can't really accelerate it.
That's right. It's like a simulator,
Yep.
whether you're in a simulator for a fighter jet or a helicopter or whatever. It's just the simulation. It's just getting reps under your belt. It's just seeing patterns play out over and over and over so you can kind of internalize them and you can start to see, yes, this one does have a propensity to win more than it does. I day trade all day long. I day trade from the open. And I've been doing that for a friend of mine. I manage his account, and I think I mentioned this the other day on my podcast, but just me sitting there and watching the frequency of these setups, but on a smaller time frame, has really improved my trading as a whole, because whatever I see on a 5 minute
Sure.
chart, when I see it on a daily chart, something goes off in my head and went, that little thing didn't work very well.
Right. Yeah. And I think one of the things I was reading about, I do a lot of white paper research on investing just because I'm generally curious about it. I think it's a just
Yeah.
fascinating endeavor. And one of the hallmarks of folks that are able to successfully develop an edge to be profitable over a long period of time is pattern recognition. And
Yeah.
exactly like you're talking about, the making sure that you focus on whatever that few sets of patterns that you want to make sure you know inside and out. But pattern recognition is a really big one. Now, you also mentioned something else that I'm very curious about, and that was essentially limiting your losses but giving your profits the potential, for continuation.
Yeah.
I'm curious how you arrive at that approach, because a lot of folks, have all differing ways that they want to approach how they track P&L and how they manage P&L. How did you arrive at that? It sounds good, obviously, in and of itself, but I'm curious what got you to that setup.
Okay. Ask me one more time. I thought I
Sure.
had it, and then at the last, I lost it.
Yeah, no sweat. I'm curious how you arrived at your approach of essentially limiting your losses,
Yeah.
but letting your profits run. Um, because when I first hear that, I think kind of high probability of losses, lower probability of those extended runs. But I'm sure if you control those variables enough, you can find a sweet spot. So I was just curious how you got to that approach of small losses, but letting your winners run.
Yeah. Well, you have to identify certain levels in the market where buyers should come in,
Got it.
right? And so, for instance, you know, deep dip buys is one of my favorite kind of approaches, whether it's on the daily or intraday. But, let's just say we have the 200-day moving average. I know buyers are fixated on the 200-day moving average. Large financial institutions are fixated on the 200-day moving average. I know that buyers should come in at that level.
Okay.
So I will buy right above the 200-day moving average. And it should bounce there because the large financial institutions come in there, they buy. If it then happens to just close below, I will just get out for a quick loss. I might get back in if it then closes above in the future. So, you could just pick a random, literally you could pick a random point, like this stock's at 100. If it closes at 99.9, I'm going to get out, right? You'd want to buy it at 101.01 or 101 cent. If it closes at 99.9, I get out. I'm being a little bit flippant about that because I don't know. I don't think that I don't think that's a real level, right?
Right.
But in the markets, the 200-day is an area where big buyers come in. And if the stock cannot hold above that 200-day moving average, there's probably something systemically wrong with it. So, you have to pick real levels where people are going to buy, whether it's the 200-day moving average, where it's near the 30 RSI, whether it's near the third ATR channel or the negative third ATR channel, where 92% of prices bounce at the negative third, and they tend to go down at the positive surge. So you have to identify those levels, but they have to be legitimate levels. They have to be real levels, not just a level you came up with in your head, like the $100 mark that I just kind of was jokingly talking about. And that's to the downside. But to the upside, getting rid of the trade, that's a whole other thing. What levels are you going to use to make decisions on above you as far as when to get out and lock in profits? Because staying in and having the courage to stay in is great, but it's not so smart just to do it endlessly, because there are levels above you that if they get rejected, that's a red flag. And those are the areas that you should probably sell and lock in profits, or at least partial.
Yeah, and I love that you added the partial component, because one of the things I talk to folks about when it comes to profit taking is, you pretty much should very rarely find yourself in a scenario where you allow a winning trade to become a losing trade, especially with the convenience of order types now. You can set a stop limit, you can set a stop, you can set a trailing stop limit. All of these different tools are really good ways to help us lock in profits. Obviously you're talking quite a bit about the 200-day moving average. Do you prefer a simple or exponential moving average?
Well, I use both,
Okay.
but for the 200, the 250-day, the 100-day, I use simple. And for the 50-day, the 20, the 20, the 10, the 5, I use exponential. I also use a 50 exponential for, I know we've talked a lot about deep dip buys, but I have a lot of other approaches that I use too. I use trend trades, mainly having to do with moving average crossovers. And I'm right with you. If it goes up a certain amount, I always phase out of my positions. I was always taught, if the market really wants to take some of your stock, give them some of your stock at profitable levels. Not all, just partial. I always like to sell into strength. It's very important. I don't like to just sell on weakness. I like to sell into strength and then get out of things on weakness. So, you have to play offense and defense as well.
Yeah. And so you highlighted a couple of your general setups that you like. I'm curious, do you have an overall favorite out of those 4 to 5 setups?
Well, I would say my return to value V1s and V2s are most likely. The market, I was taught this by Dr. Alexander Elder, makes a lot of sense, but the market's either undervalued, it's in value, or it's overvalued. And if you're in an overvalue situation, that's where most people, especially beginners, want to buy, because the headlines sound good, the vibe's good, right? The sentiment's good, but it's actually in reality, it's the worst place to buy, in my opinion.
Sure.
The market is mean reverting. So probably what I use most, because it happens most in the market, something will go over value, come back into value. I will buy it back in value. And then, if I have a good trade, I will sell it when it goes back above value. On a deep dip buy, I'm buying something under value and I sell it when it gets back to value. So that's
Got
the
it.
key. If it's overvalued, wait for it to come back to value, and then hopefully again sell it overvalued. If it's undervalued, buy it undervalued, sell it at value. You rarely go from undervalued to overvalued. You
Right.
usually go undervalued, back to value, then maybe back undervalue. So deep dip buys on indexes on the daily chart, there may be once or twice a year where they're even down there.
Right. Yeah.
So I don't use them that often. So I would have to say for a variety of reasons, my return to value is probably my favorite trade. But just because it returns to value doesn't mean I immediately buy it. I have to have a trigger. I have to have something that shows me this is the place, gives me a good risk to reward ratio. But yeah, return to values. If I could only trade one trade, it would be that.
And I'm curious, obviously, things don't flirt with their 200-day moving average necessarily super frequently. So, what are some of the other indicators you like to use if it's not near a 200-day moving average? Let's just say it's trading above it.
Yeah. So, I essentially trade deep dip buys. I trade crossover trend trades.
Okay.
I trade return to values that we just talked about. And then I trade higher low V1s or V2s. And then I trade double bottoms with bullish divergences.
Okay.
So that no matter what the market has, I have a tool to approach it. That's one of the reasons that I went from mentor, because, when I was taught double bottoms, bullish divergences by Dr. Alexander, I was like, he feels like that's the most powerful indicator in all of technical analysis. And he may be right, but it doesn't happen very often.
Right.
If you're trading in on daily, you may have once or twice a year where that happens. So I thought, okay, this is great, but I need something that I can use in all different type of markets. And that's why I went to different teachers and different mentors. So they're all good. That's why I kept going, because okay, I need an approach regardless of what the market is doing. But the return to values happen the most. Higher low V1s, V2s are really great because those can turn into long-term trends. Trend trades are good. I think the only disadvantage of those are you get in those a little bit late. That's why the higher low V1s,
Right.
V2s get you in quickly before the trend trader people come in. And sometimes I'll take a higher low V1, V2, and then it will morph into a trend trade. And then I'll switch to a trend trade approach with that because I'm already so far in the money. But, as long as you have an approach, there's so many different approaches out there. You really need to find an approach that fits your personality.
That's huge.
If you're not a trend trader, I could give you the best trend trading system in the world, but if you can't follow it, what good is it? You really have to match it to your personality, your psychology, how much screen time you have. And I think a lot of people find a book and they'll go, oh, okay, I'll use this approach, but they don't put any thought into, is this really the approach for me? There's millions of different ways to trade.
Yeah, and I really like that you kind of highlight that individual aspect, because it is something I talk to a lot of folks about. One of my favorite strategies is just covered strangle in an index ETF. So start with a short put and then let it roll from there. And realistically, pretty fucking boring. Not a lot happens in that strategy. It just, kind of does what it does. And when there's different levels I need to interact with it, I interact with it when I need to do it. Maybe it's in, 2 weeks, 3 weeks, whatever it is, but otherwise that trade's just kind of sitting there. And I know that works for some people, and then other people, they just feel like they need to hover over the trade and then they get in their own way. So I
Yeah.
think taking that time for that self-analysis of figuring out like what you do, and obviously controlling the bad habits as best you can, but still acknowledging what you do is super important for finding something that fits the way that you trade. Um, one of the things I was curious about is, after understanding some of your typical setups and whatnot, what are your, I don't know, your list of favorite products for you to trade?
You know, I generally trade the large stocks. I trade the indexes. I trade the large monster stocks like,
Okay.
Apple and Microsoft and the big stocks. However, recently, one of my students is extremely bright. He was one of the head coders at Microsoft. And like I said, he was a student of mine. And I taught him everything I knew. And out of the blue, he shows me, Greg, I coded up this scanner. Everything, every indicator, every confluence of approaches, and everything that I use, even on multiple time frames, he coded up deep dip buys, all this kind of stuff. And it's a scanner, and he runs it several times a day, and he sends me the results, and it gives you a scorecard. Like, hey, Disney had a V1, V2 on weekly. It rejected the 200-day moving average on the daily. It was also at a 30 RSI here. And he sends me this aggregate. It's like a report card. And if I look at the top stocks of the day that have the highest score, I look at those charts and go, oh my gosh, they're perfect. So it's
Interesting.
unbelievable. He took everything I taught him and he just coded it.
Right.
People don't need me anymore. They just need that
Right.
they need that scanner. And so with that scanner, I have a watch list of about 50 large stocks and indexes, and sometimes there's just nothing to do. So like on my podcast, I'll say, Apple, we need to wait for it to do this, or Goldman Sachs, we need to wait for it to do this. But every day on the podcast, he shares that with me before, and then I pick the top maybe 10. And these are not the big monster large stocks like I'm used to trading, but the setups are so good. So it's changed a little bit in the last little while because of that.
Yeah, that's really interesting. Especially, I was curious if you would stick to the large caps or not, since you're not necessarily in the product for a really long period of time. Because when I'm trading something like the coverage triangle, those are products that if I get assigned, part of my strategy is to wait. So who knows how long you have to wait for in some of those instances. So I really like to trade things that live within the S&P 500 just for that relative safety. If I'm needing to wait for an extended period of time. So that's interesting to hear that you started branching out a little bit on those shorter term trades. Do you find that there are certain products that you revisit a lot? And if so, why?
Well, I look at the large stocks a lot because, like you, I feel most comfortable with those particular stocks. So I look at those on a daily basis. But now with this scanner, it's a whole different variety. But I can tell you, if the scanner pops out great signals on Apple and Microsoft, and then there's two other stocks you've never heard of, I'm definitely picking the Microsoft. I always am going to defer to the big ones. Whenever I sell cash secured puts, I always do it with the big stocks. I want a stock that if I get assigned, baby, you know what I mean?
You feel comfortable.
I'm happy to get assigned and not some stock I've never heard of. But for the shorter ones, as long as they have, they have to have a certain amount of volume regardless. I get rid of 8 or 10 of them every day that just don't have enough volume.
Right.
But I prefer the large stocks, but I will take the small ones. But yes, the large big names in the indexes are the ones that come around the most often.
Yeah, and I think a big part of that is exactly you're saying. Any sort of active trading in general, you got to have the ability to enter and exit at a fair price. So liquidity and volume are going to be.
Liquidity is huge, and the bid-ask spread is huge.
Yeah, and especially for active trading, because you're obviously revisiting that bid-ask spread semi-frequently.
Absolutely. You know, I mean, you need something with a penny or two spread. I mean, that's it.
Yeah, yeah. I think that especially, when we're trading equities outright. So you mentioned that you do trade a little bit of options on top of your equities trades.
Yeah.
What Why is that? Why do you like to do both? And do you like one more than the other?
I'm a big fan of having a lot of different diversification in my types of trades. I don't want to just be a trend trader.
Right.
I don't want to just be a mean reversion trader. I don't want to just be an option trader. I don't want to just trade on the daily. I want to trade on the weekly. I want to trade on the daily, and I trade all day long intraday for that very reason. I want a cross section of as many different types of markets. I want a cross section of as many different types of time frames. I want a cross sections of different type of industries and different types of approaches. I just think the more that you can diversify among approaches, time frames, sectors, getting outside equities like oil, bond, golds, whatever like that. I can't remember right off the top of my head. It may have been the man who, what's the such a great book that I read, the quant firm there, oh, sorry, I'm blanking on the name. It was such a great
I'm
book.
of no help. I'm not sure which one it is.
Renaissance Technologies.
I've never read it.
Largest hedge, one of the largest hedge funds in the world, totally quant. But that was his approach. Let's trade different time frames. Let's take different approaches. Let's take different types of equities and different kind of products. And that resonated with me. So that's why I do options. That's why I do different time frames of stock trading.
Got it. Yeah, I think that makes a lot of sense, especially again when you're living off of those funds, having different things that work at different times and different conditions seems to make a lot of sense.
That's exactly right. And but with options, I'm very patient on options. I mean, I never sell premium unless volatility is really picked up, because I want real premium when I sell, right?
When you take that exposure, yeah.
Yep, exactly.
Yep. I think that makes sense. So being sensitive to the time, obviously it's a little bit later where you're at too. So what I wanted to touch real quickly, if you don't mind, is just your overall disposition towards the markets kind of leading into the end of this year and the beginning of next. I'm curious what your general thoughts are on the market itself and then your general approach to the markets.
So, the longer that I trade, the more I realize that whenever I try to take a macro approach to the market, whenever I try to have an opinion on where it is or where it's going, I'm just wrong. And I was pretty good in economics in college, but I'm just wrong. And what I find out and what I realize, I mean, that's why I'm a price action trader. I trade what the price, because it's the true indicator of what's going on. So what's happening, I mean, in the markets going forward, my gut is like, it's going to be a huge cluster, right? Sure. There's going to be all sorts of volatility, but that's me. And whenever I start to feel that way, I go, hey, remember, you're usually wrong on these things. So I am just going to trade what the market does, regardless of what my thoughts and opinions are. And I would suggest that for most people. The times that I've always gotten into trouble in trading is when I've made a conscious decision and I have an opinion like, we are too low, we cannot go any lower, or we are too high, right, we can't go any higher. We can go way higher, we can go way lower. My best advice for everyone out there is trade based upon what the market's doing, what the price is telling you. But to answer your question, I think there's going to be a lot of volatility. I'll probably be wrong. I think there's going to be a lot of volatility. I think we'll maybe rally into the election. After that, I think there's going to be some volatility. Of course, the market's doing pretty well. The real economy is not doing well. I feel
Right.
like that eventually that's going to catch up to the market because, in the long run, stocks really are a slave to their earnings per share. And depending who wins, depending what happens with the economy, I see companies suffering from that, which should lead to lower prices. I mean, if you have lower earnings, you should lead to lower prices. But in this weird, crazy world that we're living in right now, people really don't seem to care about earnings per share, which is bewildering to me.
Bizarre. Yeah.
It's just bizarre. I mean, the rally that we had off of March, I would have never in a million years expected this to happen, and here it happens. So yeah, I think we're going to rally into the election. I think we're going to have issues after the election, and then when the election's all finished and we go into 21, I feel like the reality of everything is going to catch up to the market. But that's just my opinion. I
Yeah.
could I could be very, very wrong, and I'm just going to trade. I'm just going to trade as always based upon what the volatility of the market is. So adjust my position size and then take my signals, stay in them until certain levels tell me not to. And if I'm wrong, get out quickly.
I think that the use of volatility as your guiding feature for scaling is really, really smart because it almost makes it an agnostic input. Whatever your opinion at that point doesn't matter. It's going to be you decide based on where volatility is and how much you want to scale based on that. And I actually really respect that because for me, the way that I actually view the end of the year very similar to you. I think just going into the election, I think that will be pretty steady. And then I think once we get close to it, volatility is just going to continue to tick up. And then
Yeah.
we'll see what happens afterwards. My personal approach is leading into the election, I actually will scale out. I won't completely eliminate exposure. I literally never do that, but I will just have light exposure because the way that I'm viewing the overall event here is pretty much like an earnings event. I'm viewing the election as a binary event.
Yeah, exactly. That's
Because,
why the volatility is so high, because people are
yeah,
pricing in the volatility of the election.
and there's just, so much of a robust potential output that everybody's just weighing a lot on it. So I think my general approach is scaling out, but I really like your concept of using volatility. One of the other things I was curious about, kind of wrapping up the conversation, to a really, really recent upcoming thing that I'm seeing is airlines. And a lot of folks feel all sorts of different kinds of way about airlines. Everything that I'm seeing, the five major airlines, I personally think that they are in a ton of trouble. I think they have a lot of overhead, and I think I wouldn't be surprised if there is some reorganization of those names. I wouldn't be blown away if there was some sort of merger with some government assistance to essentially keep the airlines afloat. I'm curious if that's just, a sector that you've been following at all and what your thoughts are on airlines.
Well, Warren Buffett got rid of all his airline stocks, and he's a pretty smart dude. So with a pretty good track record. So I imagine all his boys that are crunching numbers probably came up with something that he didn't like. But again, that would be my opinion on the market. And I agree with you. Yes, maybe there's going to be some mergers. Something's going to happen. But the safe place to be for me is I can have all the opinions that I want. But, the smart money in the market shows itself daily. It
Right.
shows itself in crossover signals. It shows itself in breakouts. It shows itself in all sorts of stuff. So there are people that are smart enough to figure this out, and their buying will show up in the market, and the buying showing up at the market will create setups that I will buy. So I let the people that are smart enough to figure that out, and I basically piggyback on them
Right.
vis-a-vis a setup.
And I think really that's one of the beauties of swing trading is, kind of I'm sure everybody can get the general assessment, but from your perspective, it doesn't matter. Like you essentially trade your setups, and because it's a terminal trade, meaning it's not necessarily going to go into perpetuity one way or the other, the general details don't matter quite as much on, the qualitative standing of things. And I think there's a beauty in that, because it's the same thing when I find myself scalping or, coming up with an earnings play. I really don't care about, the general news of the underlying per se, but it's more following those setups. Um, and I think that you found a really wise way to approach that. So kind of wrapping up the call, the other thing that I think would be really cool is if you were to look out, for the next 2 months or so,
Mhm.
um, where do you see volatility going in that time frame? And the reason why I'm curious about that is I've been running some back tests for election years out of general curiosity. Obviously, you have seen personally quite a few of them. So I'm curious, just, the next 2 months or so, where do you see volatility going?
You know, I think volatility is going to increase, but this is not something well, I mean, I assume that after the election, if it's contested, that's going to create volatility. But the reason I'm
Right.
saying this is because you're having all the large major brokerage firm increase their margin requirements.
Hmm.
Do you know about this?
Yep.
Yeah. So just based upon what they're saying, they're in the business. They've gone through this before. I've seen this. I've seen this back in 1999
Right.
when Amazon was $4. I've seen brokerage firms increase their margin requirements because of the expected increase in volatility. So they're all doing it. I don't think they're all wrong.
Right. Right. Yeah. I mean, if there's one thing a broker is going to do, it's pass through risk. So I think that that's actually a really interesting perspective to bring, because it's not one that I thought about necessarily. But that's super interesting. That anything that I've seen so far in the back tests mirrors that. There's just a lot of conjecture on, where things are going to go.
There's a really good back tested crossover by boy, I forgot his name now. Shoot. Um, Larry Connors. He did a book with Linda Raschke, one of the first trading books I ever read back in the 90s. But he did a very extensive back test on the VIX. When
Hmm.
the 10 EMA crosses over the 30 EMA, it is not safe to short volatility. Or in other words, when the 10 crosses over the 30, just like any other crossover on equity, there's better chance it's going to go up. So the 1030 cross is probably within a day or two of happening. If we have any increase in volatility in the VIX, any increase in price, that will cross over. And so when that does cross over, because of my own biases of thinking that volatility is going to increase in the next couple months, I will express a long trade in the VIX. I'll probably just buy
Got it.
calls, so it's a defined risk. But I can justify that to myself because the 1030 EMA crossover is a valid signal. So,
Right.
I've had this thought for a while, but I'm waiting. It's fine to have your opinion, but wait for your actual crossover, wait for your actual trigger before you express the trade. Because then you can live with yourself. If you're wrong, you're like, well, I just didn't do it out of the blue. It was an actual
Right.
cross. But, watch the VIX index in the next couple of days. And if the 10 EMA does cross over the 30, it doesn't mean it has to go up. Obviously, it could go
Sure.
right back down, but over time, that is a good back-tested approach to going long volatility, or at the very least, not shorting volatility.
Yeah, yeah, I think that that's the VIX and VXX I follow very closely for similar reasons.
I'll let you know when I get in that.
Yeah, I was actually thinking it might be fun in the future. Maybe we do a follow-on call, and I would love to see your process for parsing through a couple setups. I think that those are pretty fun to see somebody executing their preferred style. So if you're receptive to that, we could talk offline, but I would love to, partake in something like that with you in the future.
Yeah. And, I mean, if you or anybody in your audience, what I'm talking about here, I talk about every day
That's
in the
awesome.
last hour of the market. And, we look for crossovers, we look for deep dip buys, we look for higher low V1s, V2s, all this kind of stuff. And we do it in real time. You should come by one time, say hello in the chat. Steve Burns is there every day. And, but yeah, I mean, we don't just talk about it. I mean, we really do it and place trades based upon those. And, I'll tell you, doing this podcast, I think has made me a better trader because I'm trading in front of so many people. I'm trying
Right.
to set a good example. You know what I mean?
Yeah, absolutely. I found it myself because there's a couple portfolios that I'm trading right now that I share, essentially real time as I'm making adjustments and whatnot. And I found the same exact thing because there's a very clear audit, and that there are folks that are kind of, really, really carefully critiquing what you're doing, especially compared to what you say. So I think that there is a significant forcing function realistically, to kind of perform the way that you say you perform. I think that's very true.
And now that you say that, one more piece of advice I'd like to give to people, because I have found if people actually take a trade, follow their rules, even if they're not doing well, they don't get hurt too badly. The ones that get hurt are the ones that get stubborn. They get an ego. I'm not taking a loss on this. It can't go any lower. It can't go any lower. It can't go any lower. And most of the time it won't, but one time you will get one that just stomps you. And
Right.
so, if you find yourself, if you have the proclivity that, what I'm saying is resonating with you and this has happened to you, talk to your wife, talk to your husband, your boyfriend, your girlfriend, your mom, your dad, relatives, whatever. If you feel like you have that tendency, if you find somebody to be accountable to, if you explain to them, this is my trade, this is where I'm getting in, this is where I should get out. If you have somebody that's accountable, that's looking over you and accountable, you will follow your plan. If you people that trade for prop firms or in New York, or they trade for large financial institutions, they can trade for that company for 15 or 20 years and churn out profits year after year after year after year. And then they think, I can do this myself from home. They'll go home. All of a sudden, they can't make money. What's the difference? The difference is somebody was always looking over, monitoring their trades. They couldn't let loss get too out of control. When you go to your home, no one cares.
1v1.
So, if you can get a family member, a spouse, whatever, just a friend, if you find yourself falling into that trap, ask them a favor, say, look, these are my trades. I want you to make sure that I'm getting out when I'm supposed to. It's not a weakness, it's a strength. If you know you have the weakness and you ask somebody to help you with it, it's a strength. And I guarantee it will help.
I agree with you. It's something I do, if not weekly, a monthly review with my mentor on what I'm doing to this day. And it's for that exact reason. Just having, I always call it an external audit. And I think having that external audit does exactly as you say.
Yeah,
It
then you have to be accountable to somebody.
yeah, I love that. So obviously it's getting a little bit late. So we wrap this thing up. I really, really appreciate your time. I think it's always fun to connect with traders, especially that have different style like you, that are successful like you, and that have a really good approach to the markets that's well defined. I think it's really helpful for folks to see stuff like that. So sincerely from myself and obviously the audience, we really thank you for coming on and taking some time to chat with us.
Thank
We'd
you.
love to
I'm
see you
glad
again.
we finally got this together, man. And
Yeah.
it's an honor. I appreciate you having me on.
Yeah, would love to connect with you again sometime in the future if you have some time.
Absolutely. And keep up the good work. I mean, I'm really glad to see what you're doing and, helping out the military community and getting them, exposed to this and, hopefully learning a correct way to do it. But yeah, you're doing good work there.
That's awesome. I really appreciate you saying that.
Yeah.
So otherwise, hope you enjoy the rest of your Sunday evening, and we'll catch you next time.
All right. Thanks, Eric.
Take care, Greg.